Hello, this is Josh Belk with Belk on Business Podcast. Hope you're having a wonderful day. Today, we're going to pick up on a topic we started last week, working through some of the components of this big, beautiful bill that was passed earlier this particular month. Last week, we talked through a few of the campaign promises that President Trump had made and what they're going to end up looking like in this bill and how it's going to apply to taxpayers. And so last week, we talked about the no tax on tips, deductibility of car loan interest, as well as no tax on Social Security. Today, we're going to talk a little bit about the depreciation component, which is one of the more popular components of the last bill in the first couple of years, as well as this particular bill, especially for many of our clients who own real estate and our real estate professionals. They are able to utilize this particular strategy to be able to essentially write off a lot of their income. We'll talk a little bit about that, some of the changes as it relates to Section 179, which is one of those sections as you look at as far as depreciation or being able to fully expense an item. And then I mentioned a little bit about some of the changes that relate to deductibility of interest, which was kind of the more bigger and kind of confusing components of the Tax Cut and Jobs Act. So first of all, the bonus depreciation. The Tax Cut and Jobs Act passed in 2017 allowed for full depreciation, and there was a phase down of the depreciation percentages over the last few years for certain qualified property. And so basically it was any sort of property that fell within the 15-year depreciation timeline or less. So you think like furniture and equipment, fixtures in a property. You think about appliances, things of that nature, as well as any sort of leasehold or land improvements, which are the 15-year category. And so those particular categories, it allowed for full 100% depreciation. Now, over the last few years, it's dropped from 100% to 80% to 60%. Now, what we're going to see starting in 2025, that bump back up to 100%, and this is permanent. So if you have a property, a rental, for example, and you go through and you purchase the property. So say you go through and you're a real estate professional and you purchase a rental, and that rental costs you $200,000 for the rental. What you would need to have done is have what's called a cost seg study. So you'd have somebody come in, and what they do is they break apart that real estate into smaller components. So they'll tell you how much of it is considered the portion that should be depreciated over 27 and a half years. Then they'll break into the land improvement section, as well as into the furniture, fixtures, and possibly equipment areas in the particular report. And so you end up in a situation to where any assets, and this is just real estate, any sort of a business, if you have any sort of 5-year, 7-year, or 15-year property that goes into service, or you purchase that year, you can fully depreciate that item within that year. So the permanent restoration of the 1% bonus depreciation for eligible property. Secondly is 100% expensing of factory and plant property. And so we don't have a whole lot of clients in this area, but we do have a few. So the factory and plant property must be new construction and original use by the taxpayer. So if somebody else built it and then for themselves, they didn't use it and sold it to you, I'm not quite sure if that's going to work. But if you go through and you had the building constructed, and then you are the original use of that particular factory or plant, then you can be eligible up to write off 100% of the expenses. Okay, and so the construction must have been between January of 25 and 28, and then a cost seg really should be run because there will be certain components that will be excluded, and so and I'll talk about that here in just a moment. Section 179. Expenses. So if you think about the shorter term property, so normally historically it had been tangible property. So if you went through and you purchased equipment, you purchased furniture, things of that nature, you could utilize Section 179 and fully expense the property in that year instead of using depreciation. Okay, so but that expense limit has been increased, and it's also there are other types of property that are now included. So the expense limit is increased to $2.5 million, up to a phase out over up to $5 million. So most businesses are going to fall under that 2.5, at least in our within our clients, are going to fall under that $2.5 million. But if you are in a situation where you have over $2.5 million in that property, you're going to see a phase out of Section 179. But you can always go back and utilize other strategies. This section had only permitted Section 179 to be used for tangible personal property, but now it includes such things as fire systems, roofs, HVAC systems. You think even in a rental property. But if you have an active trade or business and you do any of these things, it qualifies for full expensing. For example, you go through and you have a rental property, you replace the windows in that rental property. You're able to fully expense those items where before you would had to have depreciated them over the 27.5 years. Same thing with HVAC systems, with roofs. So these areas had to be fully depreciated. But now they can be included as part of Section 179. But it has to be, once again, for an active trade or business. So if you're a passive real estate investor, for example, okay, so it's not a trade or business, or defined as a trade or business for you, meaning it's what you do full time, essentially. Maybe to oversimplify it a little bit, but if it's your trade or business, it's what you do, then you will be able to qualify to use this. If you're a passive investor, you go through, you just happen to own some rental properties or rental portfolio, somebody else manages it, you don't really mess with it, it's passive, you will not be able to use Section 179. So back to the full depreciation of any sort of factory and plants. With that particular item, you'll want to have a cost seg report also done because there may be certain components that are excluded. So opportunity zones and I'm just going to briefly talk about this. I just got off a phone call here about a half hour ago and talked a little bit about this. If you're looking to buy into an opportunity zone fund, it's probably really good to have a little bit of a lengthier conversation with your CPA or tax professional to make sure that you're doing it right, because the rules have changed. So this isn't just simply taking the old, so this particular section simply isn't taking the old rules and modifying them. This is an entirely new law. Now it has some similar components, but there are some changes. So the changes it relates to designation periods, eligibility amounts, improvement threshold, and the gain deferral window, all of those have been modified. So if you're familiar with the old rules, you'll want to make sure you get acclimated to the new law before you move forward and invest. There are more reporting requirements with the new OZ law. So it must be a fund. You can't just go and buy a property in the opportunity zone. And then if the capital that is put in there must have been derived from capital gains, otherwise it will not qualify. So if it's ordinary income, whatever the case may be, it will not qualify. It has to come from capital gains. Have to go into the opportunity zone fund. Now, if the fund is held for 10 years, there's a 10% discount on the deferral of the capital gains. If the OZ property inside of it is held for at least 10 years, you can avoid capital gains altogether, capital gains tax, as well as depreciation recapture. So if you're looking to go into an OZ fund or invest in an area that qualifies, then in that case you'll want to pay attention to the rules, make sure that you're following them. That way you can go ahead and take advantage of either the deferral or the complete elimination of the capital gains tax on the transaction. And then lastly, for today, just real briefly here, the modification on the 163J, which was the interest or disallowance of interest expense over certain thresholds. And so this has been eased up some. So before, those calculations were run on EBITDA, which is the earnings before interest, tax, depreciation, and amortization. Now that calculation is run off of EBIT and does not include the depreciation or the amortization. So we did have a number of clients that kind of reached that phase out of being able to deduct interest on their business tax return, where now it's going to allow for a little bit more of that interest to be included, because it is excluding two of the elements, depreciation and amortization, in the calculation. Calculation is a little bit difficult, a little bit complex. If you are in a situation where you have a business with a lot of interest, you'll want to be aware of these rules. Once again, have a conversation with your CPA or tax professional to make sure that everything's set up in a way to where you can utilize as much of that interest deduction as you possibly can. So once again, talk a little bit today about the restoration of the bonus depreciation. Starting in January 20th of 2025, expensing of factories and plants, Section 179 changes, opportunity zone changes in that law, and then the modification of the interest expense deduction. Once again, this is Josh Belk with the Belk on Business podcast. Hope you have a wonderful day.